Silver's already trading near $96 per ounce, so let's clear something up right away. This is no longer an early bull market discussion. This is a late cycle, high volatility, momentum-driven phase, and that completely changes how we think about upside, targets, and risk. When silver reaches these levels, price is no longer being driven by normal supply and demand alone. What takes over is reflexivity, where rising prices attract attention, and attention brings capital. Capital pushes price higher, which creates even more attention, and that is where silver historically becomes explosive. The bullish case from here depends on four things continuing to line up at the same time. First, physical supply staying tight. Silver's mostly mined as a byproduct of other metals, so production cannot quickly respond to price spikes. Even at very high prices, new supply does not magically appear overnight. That's what allows silver to overshoot. Second, industrial demand staying resilient long enough to matter. Solar, electrification, grid upgrades, data centers, and electronics all rely on silver. Demand destruction does not happen instantly, it lags price. That lag is where blow-off tops form. Third, macro conditions staying friendly. Falling real rates, a weaker dollar, rising liquidity, and a strong gold price all act as fuel. Historically, silver does not lead. It chases gold, and when it does, it tends to overcorrect to the upside. Fourth, investor behavior turning emotional. ETF inflows, retail buying, headlines about shortages, and fear of missing out all compress time. Moves that normally take years happen in weeks. So the real question isn't whether silver can go higher from 96. The question is how far it can go before something breaks. If this remains a strong but macro-driven bull market, the most realistic continuation target sits between $105 and $130 per ounce. That range reflects continued momentum without assuming a full-blown panic. If silver enters a true mania phase where price feeds on itself and liquidity overwhelms fundamentals, then overshoots into the $130 to $175 range become possible. These moves are fast, unstable, and emotionally exhausting. They do not last long. Anything beyond that moves out of a normal bull market and into a monetary event. That requires loss of confidence, policy shock, or market structure stress. Possible, but not the base case. What matters most is understanding how silver tops. It does not drift sideways. It accelerates upward, prints a vertical move, and then collapses faster than most people expect. 30 to 60% retracements after the peak are normal. So if everything plays out perfectly from here, the most realistic cycle peak sits around $130 to $150 per ounce, followed by a sharp and painful bear market. Silver rewards patience, but it punishes complacency. And the closer price gets to those upper zones, the more important discipline becomes. If you want the roadmap for what conditions typically appear near 110, 130, and the final peak, make sure you stay tuned. Now let's summarize the four pillars quickly as a refresher. First pillar, physical supply remaining tight and slow to respond. Second pillar, industrial demand staying resilient long enough to matter. Third pillar, macro conditions aligned. Rates, dollar, liquidity, and gold all supportive. Fourth pillar, investor behavior moves emotionally and rapidly. Thank you for watching. If you enjoyed this, stay tuned for more deep dives into silver and macro markets.